Welcome to the SWU Financial Podcast, your go-to podcast for navigating the complex world of finance. I'm Jonathan, your host and financial guide, bringing you the latest market trends, investment strategies, and financial news that matters to you.
At the SWU Group, we help everyday families achieve financial success. Our integrated services include financial planning, accounting, credit advisory, and estate planning. We're here to guide and support you every step of the way, from custom investment strategies to maximizing tax efficiency. We ensure your financial goals are met with peace of mind. Visit simonwu.com.au for more information.
All right, so hey everybody. So welcome to the first episode of the Finance Garage. I'm Jonathan Wu. I'm the principal and senior financial advisor here at the SWU Group. And for my first episode, I couldn't think of a better person to join me, someone who I've known for over 20 years now. Monik Kotecha, who's the Chief Investment Officer at Insync Funds Management, and you and I have known each other, over 20 years back in the days of Investors Mutual.
It has been. It's been a very long time, and I'm amazed as to how young we both still look.
Yes. And on a podcast, no one can see,
exactly.
So it's completely fine with regards to this. But I mean, I remember, Monik, when I was at Investors Mutual for those 2 years. I remember it was you and another portfolio manager, Jason, who taught me how to calculate free cash flow when I was 18 years old, and something that I'll never forget. So that was my probably one of my first initiations into investing and looking at companies. So
that's good to hear. Well, probably one of the most powerful concepts to appreciate in any business, as you know, running a business yourself now.
Correct. So I mean, you've seen a lot of market cycles, Monik. You've worn many different hats across the world, investing in equities. If we sort of kick things off, I mean, we've recently seen a violent bout of volatility in a very short amount of time. And, there's a mixture of potentially some negative news out of the US from an economic standpoint, right? Some payroll data. You've got unwinding of Japanese, carry trade, where everyone's sort of rushing for the door at the same time because the Japanese central bank decided to increase rates, right? How do you see the situation?
Yeah, I mean, coming out of, and answering your question too at the same time, hopefully, but coming out of COVID, we're in a very different environment. As you know, there was a major supply-demand imbalance coming out of COVID. So when demand came back, the supply wasn't there. So that created part of the inflationary shock, which we're still working our way through. Part of it was just a major response by governments where they really pumped the economy to stop it from completely collapsing in their view, but I think in the process they gave out too much money, so there was a lot of excess savings. And COVID itself also accelerated some of the trends. For example, retirement. A lot of the older generation just moved out of the workforce because they just felt life was too short. They had extra money, and so that created a supply-demand imbalance in the labour market too. So they all came together, and that's why we saw those rapid increases in interest rates last year, because inflation suddenly started to surge because we had this demand surge, but the supply wasn't there to meet it. And we're still sort of working our way through. And the good news is inflation is coming down. But there are other factors at play. So in terms of, that's a little bit of context, because I think that's the big change from pre-COVID, where in a post-COVID world, it does feel like interest rates are going to be higher, even if they are coming down, than they were in a pre-COVID environment. And that has a big impact on investing generally, because for almost 10 years, everyone was used to rates coming down and staying low and inflation staying low. And the environment we're in now is distinctly different. So I think that's a big thing. I think specifically with the Japanese carry trade, which is what this is all about, the current bout of volatility. There were other factors, but there's always factors at play.
Of course.
Presidential elections cycle every 4 years, and there's typically quite a bit of volatility. You've got to remember that there are seasonal factors that typically play this time of the year as well. So July, August, September, parts of October tend to be seasonally more volatile. So that probably contributed a little bit to the volatility as well. Sure. And then we had, obviously, as you said, the payrolls data that initially there was only one data point at that point in time that
It's the non-farms, wasn't it?
yeah, which freaked everyone out because they said, "Oh, we're now heading into recession."
Yes.
But there were weather-related issues as well.
Yep.
So, look, there's always those things also tend to be revised up and down significantly. So the data point you see is not necessarily the final data point. So the market, I think the big thing was just the short-term issue, which was basically the unwinding the carry trade, and that essentially is what investors did is they borrowed in Japanese yen because rates were ridiculously low.
Yep.
And you got a declining Japanese currency. So if you're a US dollar-based investor, borrowing at low rates, and you're paying back when the currency is declining. So they use that and they leverage that up to go and buy Mexican pesos and I'm being extreme, but Argentinian bonds, even though we know risky because they're at 15, 20, 30, 40, 50%, whatever it is, right? And so when rates went up, the Japanese currency obviously had a rally. They were forced to liquidate that. So in a very short period of time, we had the intense bout of volatility. So I think that in itself was just a narrow window. I don't think that in itself is well, there is still some systemic concerns around that. Is there more to unwind? But that seems to have stopped, and obviously the central banks of Japan have come out and basically said, okay, we've
Calm everyone down.
Calm everyone down. We're not doing anything now for a while. So I think that will come down. So I think that's the situation in terms of explaining that current bout of volatility.
But do you think if we use the Japanese unwinding of the carry trade as an example, and it was so violent so quickly, do you think that is any reflection of markets broadly being more fragile compared to, I don't know, say pre-COVID, or is this? Do you think this is more isolated?
It's a good question. I mean, is it more fragile? I don't think it's necessarily more fragile. I mean, you do get. Looking back over time, going back the last 60 years, every 4 or 5 years, there's a major correction in the market in excess of 30%. That's been the average. Now, we've gone through years longer than that where we haven't had that big correction. But typically, you do get those types of correction. And so the current bout of volatility, I don't think necessarily leads one to conclude that the markets have become more fragile. I think what's occurring now is that we are in a very different regime, investment regime. And normally when you move into a new regime, most investors take a very long time to adapt to it. They don't realize it's happening until the benefit of a number of years of seeing it, and then they go, oh, right, now I can see what's going on. So as I said, if you think about the regime we're in at the moment, we've got probably higher interest rates for longer, even though they're coming down. But you've got probably, it's very hard to predict economic outcomes and inflation. So there is probably, you could argue, a bit more volatility in your capacity. I mean, those things you can never predict with accuracy, but they do tend, it will be more volatile. And then part of it's also been driven by obviously global geopolitical fractions that are occurring now. And everyone's obviously onshoring and bringing a lot of the domestic supply. Everyone's worried about the energy supply, and those disruptions are also creating volatility in the economic cycles because pre-COVID world, the world was a beautiful place and everybody was trading with each other. Whereas those things are now become disruptive. So, and then there's some other major disruptive factors at play as well, Jonathan. The two other major ones is demographics. I think people understand there's demographic shifts occurring, but I don't think they fully appreciate how quickly and how rapidly it's occurring. We're probably seeing the most profound demographic shifts almost ever. I think, and the other one is obviously technological, and obviously with AI coming through now, but that's actually accelerating, and that's creating a lot of disruption. So that's the new regime. So in a way, for an active stock picker, it's actually much more exciting, right? Because it means that you really got to be quite focused, and you need to pinpoint those investments as opposed to just having a broad-based approach.
So if we knock that on the head in the sense of, okay, did the unwinding of the Japanese carry trade create any opportunity for you to pounce on right at that moment? 3 weeks ago. I mean, we're recording this on mid-August, so about 2 weeks ago.
I mean, we tend to invest on a long-term basis, and the Japanese fall was very Japanese-centric. So it did have a ripple effect to other parts of the world, but we didn't see the extent of the same falls in other markets. Now, if you think about the other markets like the US, and we know it's been concentrated in terms of where the returns have come through from, those stocks weren't certainly much more attractive because they fell back 8 or 9%. They've all had enormous returns over the last year.
Yep.
And certainly in our process, we do like one or two of them still because but we do spend a lot of time as part of our total process looking at valuations. And if anything, the last 12 months, we've been trimming that quite aggressively. And that's the part of the market that was probably the most volatile in terms of the pullback. But because the other stocks didn't, and they make up the large part of the market, right? So if the market goes up and down, those big stocks are actually moving it up and down.
Yep.
But if you look beneath the surface, those stocks didn't probably suffer to the same extent.
Yeah.
So there weren't any sort of startling opportunities just because of that. In Japan, if you were very focused on Japan, I would say there were.
Yes.
Yes.
Because you had things like, and it was quite interesting because that ripple effect, obviously, as you know, Monik, I look a lot more into Asian markets, right? And Korea dropped 10%, right?
Yes.
In a day. Like that's violent. That's beyond. You can have Samsung drop 12% in a day.
Yeah.
It just seemed very, very violent. I was talking to another portfolio manager on that day because we were actually in New Zealand on a marketing trip, and he said he believes one of the other reasons why sort of bouts of volatility going forward is going to be more violent is because of the sheer volume of money that's in ETFs, right? So there's this forced seller mentality when markets fall, rebalancing occurs, and it's everyone out the window and then everyone back into the window when markets jump back up, right?
Yeah.
Whereas, if we went back 10, 20 years ago, there was less ETFs in terms of their power or scale in the marketplace.
Yeah, look, I think there's some validity to that. I would probably agree with that, and that's why I think again going forward, if you can pinpoint the stocks. I mean, if I was, we already had good exposure to the semiconductor space through other companies, which we're probably more keen on. But we did look at Taiwan semiconductor company that fell, and we went, But having said that, because we already had good exposure, we didn't want to add to our existing exposure because you need some risk management when you're thinking about portfolio structure and balance. You don't want to put all your eggs in one basket because then you're riding up and down. But I did think that if I was an existing TSMC investor, that would have been a no-brainer. That would have been an absolute no-brainer. So there were definitely opportunities, so those periodic bouts of volatility, you've really got to be. If you've got to have that conviction on the stocks, and then you've got to pounce on it.
So I mean, this is a good segue into active management, right? So Insync was founded in 2009?
Correct.
Yeah. So, you've developed a process over time in terms of trying to systematize your investment philosophy and how that manifests itself through actual action, right? So, I mean, from your perspective, can you sort of, in a quick summary, I mean, how do you believe, or why do you believe active management is still alive? Something that, I've been debating with the industry for years, right? Given, as I've said, this massive inflow into passive and active ETFs, right?
Yeah,
in the
that's
last
a good
decade,
question.
Right? Is active management in of itself a dead art?
Yeah. Right. Well, it's almost counterintuitive. The more money that goes into passive, the more attractive active becomes going forward. And there are problems with passive. I mean, as you know, we look at secular long-term trends. We call them mega trends, which are very distinct from fads and short-term themes. These are long-term durable trends. But what happens is the ETF manufacturers suddenly find a new trend, and what they do is they latch onto it and they build an ETF. But the ETF isn't well thought through. They'll go and buy a basket of 15 or 20 companies that are exposed to that secular trend, assuming that a rising tide lifts all boats.
Yes.
And there is conclusive research that actually shows that by the time they launch the ETFs, all those ETFs actually go on to underperform significantly. Okay, and the reason being is because in the early stages of a mega trend, you get a lot of competition coming in. Everyone's very excited about the trend, so you get a lot of speculation into the investment. A lot of money comes in. And when you get too much money chasing something, what happens? Your margins go down, your profitability goes down. There's a lot of exuberance there, and you get a bubble basically. It's like part of the hype bubble. So if you look at the fullness of time, only 4 or 5% of all stocks actually outperform over the long term.
Really?
That's right.
That's surprisingly low.
Yeah, it is very low. So it's only 4 to 5% that actually help you compound those returns over time. So if you genuinely are an investor in the stock market and you understand that, and you understand the drivers behind that, then you realize why active is so important at the end of the day. Yes, on an annual basis, passive will outperform from time to time, but on the very long-term basis, if you stick with a strategy or with a professional that understands those attributes at the end of the day, you will probably get a much stronger outcome in the long term because of that only a few percent actually outperform. So what passive has basically, and then you've got to remember it's a very competitive market out there. So it's a bit like picking stocks. You've got to go and pick the fund managers, right?
Yep.
Both. If you're going to pick stocks yourself, well, you've got to be smart and thoughtful and have a proper process. And if you're picking the fund manager, same. There's a lot of fund managers out there. And so what the passive will say, well, look at the average fund manager. But obviously the average is not going to be great, right? So like everything, you got to go and pick those managers that are going to do the job for you and deliver the returns for you.
Yep.
And there are many of them around. So I'm obviously being an active manager, but I still see a great place. And as I said, ironically, as more money goes into passive, the greater the opportunity I see, because I see greater opportunity for mispricing, and that mispricing will come through. So, when you get those periods of downside volatility and active sells down, passive sells down, within that you get opportunities, to pick up some really attractive opportunities, or you may already have some that don't fall as much because of that. The other benefit of active, though, going forward is that it's where we started the conversation. Economic volatility has probably increased. It's harder to predict, and therefore market volatility generally will probably be on the rise. Okay. So whilst we're a long-term investor, there are points in that journey where you want to be involved in a position and then you want to get out of it. And you need a highly systemized process to give you very clear signals as to when to do that. And that's what we've developed at the end of the day. So a good example, something that you and I have spoken about, was Louis Vuitton, LVMH. It's a stock that we've liked for many years. There's more millionaires today than ever before. And they're very specific about what brands and products and services they buy. Being very affluent, they want to know. They want people to know that, hey, they can afford something that the mass or the middle class.
I'm rich.
I'm rich. I'm rich. Exactly. And certainly Louis Vuitton fits into that category. So there's significant tailwinds, but the luxury industry does go through cycles nevertheless. It's going through a cycle at the moment. And so that's a stock we owned for a while, did really well. Their earnings and their revenues in 2023 were 50% higher than 2019 coming out. So imagine it's 50% higher 4 years later.
That's incredible.
That's for Louis Vuitton. It's not a small cap company. It's the largest, branded goods, luxury consumer goods company in the world to achieve that. And part of the reason was because the number of millionaires that came through accelerated, and because they had more money, Louis Vuitton could almost increase their prices by 30%, but because only a few people can afford their products, you can buy it, their demand for that, they were able to sell their handbags and everything at much higher prices, and in fact the volumes also went up. But there came to a point in time where it was more than reflected in the share price. Now, you need to have a structure and a system in place to tell you that, because quality companies do trade the market. It's a bit like going to a neighborhood. With all due respect, but you live in Double Bay or you live in Greenacre, for example. You're going to be paying a lot more for Double Bay, right? Yes. And investments, equity investments, are the same at the end of the day. So
Is there a, sorry to cut you off there, but is there a correlation? So talk about Double Bay versus Greenacre, right? Or Louis Vuitton versus Kmart, right? Do you believe that as a theme, that if you pay double as much, the quality or the underlying cost is double as much? And is there a correlation there? Or is it playing the brand power where a scarf from Louis Vuitton will cost 10 times as much as the one from Target? Actually, it's probably more than that. It's probably 20 times more. Yeah. Is it actually 20 times better in quality, or is it really like double in quality and the rest of it's just branding?
Yeah. Oh, look, there's obviously a lot of branding that occurs there, but it's not all fluff at the end of the day. I mean, if you take the Hermes, which is probably the next level up from Louis Vuitton, so I would say that's probably the most superior luxury brand in the world, and they play on the concept of scarcity. So if they see their products flying out the door, they stop manufacturing that very
I
quickly.
did not know that.
Yeah, so they don't want to sell too much, and then
Yep.
they'll go and do something else because it's highly desired. That's what's built the Hermes brand equity. People know it's scarce, and therefore, and now quite often, even with a bit like Ferrari, you know, like if you want to go and
Yep.
buy a Ferrari,
Yep.
you can't just rock up even if you're rich and buy a Ferrari.
Yes.
They'll give it to the previous owner. So it's again that scarcity.
Yes,
Hey,
yes.
we're going to, if you want a new client to come in, they've got to work really hard to get into our ecosystem at the end of the day, right? So, and interesting, so that's the very specific segment of the pyramid, I would say, luxury pyramid. You know, a Hermes Birkin bag is outperformed the S&P 5. I mean, I'm invested in equities, but this is the average.
Yep.
It's outperformed the S&P 500 going back the last 30 or 40 years because of the scarcity aspect. But you're right, in terms, it's hard to understand what that extra value you're getting.
Yeah, correct.
But I don't think the customers who buy that think about it that way. They just see this as super premium and only I can afford it.
Yeah.
So it doesn't have. It is definitely better value. I mean, they are better handcrafted, you know, et cetera, and they've got obviously the best designers and the best sources of raw materials effectively to make this beautiful scarf. So
I
they
mean,
all contribute.
I mean, it sort of brings up something I recently attended a sort of a Porsche drive day, and all the owners, like we were just talking over lunch, and everyone sort of had this consistent agreement that there is no financial justification to buy a Porsche. But the fact that every day you jump in your Porsche and you feel like $1 million, and that is the justification, right? So that's the value versus cost concept per se. But I remember watching this YouTube video probably 12 months ago that talked about an exercise a UK man did, and he wanted a Porsche GTR S3, which is like the pinnacle of Porsches, right? And to your Ferrari theory, you can't walk into a dealership and get one. No one will outright tell you can't, but then they know that they will find a way for you to buy a Boxster Cayman, then a Macan, then a Cayenne, then a Panamera, then a 911, then a 911 Turbo, and then you'll have the opportunity to join a list to get a GTR S3, right? And it's not a dollar value thing, but what they do is that because of the power of the brand, what they're effectively doing is they're making you buy all of these cars, then trade it in to get less money back. So they basically got what they call, I guess, I remember a term fund managers like yourself would use is like what lifetime value of a customer. That's what they're playing on, right?
Yeah. It's a good point.
So I mean, does Hermes do the same things? Like that
It does,
they measure the lifetime value of a customer.
Oh, it does, yeah. I mean, I had a friend of ours who went to Paris recently, and she's not a Hermes buyer, and she wanted to go and have a look at a Hermes shop. Okay. Well, she had to make an appointment.
Oh, you have to make an appointment to go to Hermes?
Yeah, then she turned up, and they kind of knew. And I think what they do with these places is it's what you just said is, okay, if you want to join the club, you've got to start at the entry level and work your way up at the end of the day. And, you know, even if you win the lotto, they won't let you buy that, even if you could pay double, they won't let you buy that car because that's just a one-off profit from them. They want that recurring profit coming from the customer base at the end of the day. Yeah. So, but I think going back to, you know, the importance of active versus passive, I think in this more volatile, disruptive world, you've got to have, you can't just sit there debating stocks. You've got to be able to crunch all the numbers. And it's very complex at the end of the day. You know, you've got a lot of factors that drive stock prices. Ultimately, it's earnings growth, sustainable earnings growth that actually delivers a higher share price. Yeah. But what are the fundamental drivers behind that? And, you know, we've identified 13 or 14 broad ones that we use. There's a bit more than that we think drives the stock price. But if you think about that, they're all moving all the time.
Yes, correct.
Right? So, you know, you've got your return on invested capital, you've got your margins, you've got your free cash flow, you're generating your cash flow conversion, which is how much of your profits actually converted to cash. The higher the number, the better your business, because profit is just an accounting number.
That's correct.
Cash is what you can put in your pocket and go and spend.
Yes.
And then you've got, then you've got your valuation drivers, and there are lots of different valuation drivers that drive different businesses. So we measure, 4 distinct ones there. Okay. And then you've got the riskiness of the business as well. And that's what I was coming back to quality, because what happens is people go, well, this stock's only growing at 6% per annum or 7% per annum. Why is it trading on 30 times earnings? I don't get it.
Yep.
Well, it does, because it's got the quality attributes as a business of a Hermes. if that makes sense to you.
So hence it actually justifies it.
It justifies,
even though it's quite high.
Yeah. So what I've got a young analyst who's just joined me. He goes, "Oh, I think this is too expensive, and it's on this multiple, and he's grown up in this sort of valuation-driven, CFA. That's what the CFA does. It just forces everyone to look at a certain way, and it is obviously a good thing to do. But the problem is the whole industry now understands analyzing businesses the same way, whereas the market actually does it differently.
Correct.
So you can just see there that if you just looked at valuation, you would not buy on Microsoft, for example, right? You'd be going, Microsoft has continued to re-rate for 10 years because its quality attributes have continued to increase, It's in all the right space. We know what Microsoft's involved in.
Yes.
Everyone touches Microsoft, right? At the end of the day.
You can't avoid it.
You can't avoid it, and they've got subscription revenues,
Yes.
one of the biggest players in the cloud. They've got to be one of the biggest players in AI with investment in OpenAI. They're one of the biggest players in cybersecurity. And these are all hot growth areas, but they're making a lot of money out of it right now. So if you just looked at valuation, you wouldn't own the stock. So what our system does is says, well, okay, there does come a point where valuation is, so Hermes, for example, we can't buy now.
Okay.
Because even though the quality is amazing, it's got very highly profitable, very low risk, but it's so high. So relative to everything else, it's quite low.
Yep.
Whereas other stocks, you might be going, well, that looks quite expensive, but it's still in the top 10 in our universe because the quality attributes are still much greater than what the valuation is attributing to it. Now, mentally, we can't process all that information. I can't process all those factors and go, it's a buy or a sell, right?
Yep.
So what the system does is it's sort of 70% of our process says, okay, this thing now is a buy. Now go and do that extra work just to make sure that it is a good business.
So this was going to be my next question. At what point, because obviously your universe is Equities, right, which is almost 3,000 companies. I mean, what is that line in the sand at the 70%? Does your system effectively just output all the most attractive names? And, how much of an effort is it for you and your team to complete the last 30%?
Good question. So the first thing is our broad universe is Equities, but our actual universe is about 200 stocks.
Yeah, okay.
All right, because what we've done is we'll drill through it, and there's two key things we're looking for. One is it highly profitable? So we use return on invested capital. So it's a bit like your business at the end of the day, Jonathan. You think what you've got to think about is, okay, what's all the money I've invested in this business? Your money, all the debt, and what is the net profit you're making today on all the money you've invested?
Yep.
And the higher the number, the better your business. It's kind of obvious, right?
Yes.
So if you look at the average return on invested capital in the market, it's about 12 or 13%. Across our portfolio, because we're so focused on it, it's 40%.
Wow.
3 times the market average. Okay?
So that weans out a lot of companies already.
So
effectively.
40% is not our threshold. It's just the average across our portfolio.
Yep.
But that does wean out a lot of companies. Okay.
Yep.
And then the second thing it needs to have is it needs to have a runway of growth, which is where the mega trends comes in. Because so the way to grow your business, you may be going, it's great profits, but your profits aren't growing, right? So it's very profitable. You might have invested $1 million and you're making $400,000 a year.
Every year.
But you're making just 400 every year.
Yep.
To grow, you need to invest to grow the business, right? But you need to reinvest. And what the mega trend does is gives us a clear line of sight that the company has a runway of growth to keep on reinvesting. So if all your $400,000 in profits is actually cash flow, you might be going, well, I'm going to reinvest 200 of that. And if you make a 40% return on that, that's probably the best place to invest, right?
Correct. Yep.
Right?
Yep.
So you've just made another $80,000 and adding another $200,000. So your business now has got $1.2 million invested, and you're making $480,000 in profit.
So there's proof it can scale.
So you can prove that it's scale. So when I look at those two things, it narrows down to 200 companies. Then from the 200 companies, obviously we know the companies already quite well, and we know the mega trends, but the extra 30% then is then we've already got a portfolio. So it's not like we're going for the next 50 stocks. 1 or 2 pop up, and they take time to pop up. By the time they get there, we go, right, we need to now spend time on this and make sure that the mega trend is there, that it's still profitable, that the industry structure is still attractive, that the management they're good at allocating capital, so they're reinvesting, and they're reinvesting, getting good returns. Any excess cash flow is going back to shareholders, because don't forget, this is the problem in Japan, right? So they were profitable, but all that money was sitting in cash.
So cash cows, lazy balance sheets.
And so your return was coming down. So the ROE in Japan, which is why there's shareholder activism now, and that's why they've forced them to say you need to spend the cash and restructure. The ROEs were below 10%, like 7-8%. And so the market's going, well, we're not interested. We're not even interested in investing in those companies because you're going to give them more money. They've already got a lot of money. All they're going to do is just going to sit on cash. So why would we bother, right? So that's how we sort of narrow the universe down, and that's where the focus comes in. So at any point in time, we'll look at one or two stocks, and then as a team, we look at it together.
Okay.
Because we're not throwing new ideas every week. Okay. So.
But how active are you in managing your positions in the sense of, there's about a volatility top up? There is when you've initiated a position at a particular weight, you've already decided, okay, if it goes up by 20% from this point without any other change in dynamics, in terms of our metrics, we got to start trimming.
Great question.
Does that create a lot of movement for you?
A little bit of movement. I think if anything, it's probably going to be a bit more going forward. So it's not like we're turning over like tomorrow.
Yes.
But because of the environment, and this is where the active plays a critical role again, right? Because things move around. So I'll try and give you 2 or 3 examples, it's live examples of what we've done, just to tell you how it kind of works. But the way we build portfolio weights, again, that's quite interesting. So I don't sit there with my team and go, well, we've just bought Zoetis, which is the leading provider of vaccinations and medications to the pet industry, which is, as you know, is a megatrend, right? Yes. And in fact, it's accelerating post-COVID. So if we get time, we can talk about it. And so taking that as example, so what we do is all the stocks we have in our universe, what is it? There's some 200 stocks in the universe. We rank every stock in the universe, right, based on those 13 or 14 metrics individually. So we rank them from 1 to 100 effectively. I mean, there's 200 stocks, so it's done by percentiles. So it's 1 to 100 on every measure, and then we get a composite ranking. Okay. So then, and that gives us the score, and that's how and then what is the scoring actually tells us how much of that stock to buy. So Zoetis, I could say, look, I like the stock, it's great, I want to buy 5%, but the system is actually saying on a score of wherever the score lands, you can only buy 3%. But this one you can only buy 4%. This one you can only buy 2%. This one you can only buy 6%, right? So we're letting what we call our algorithm determine the scores. And it's actually very good because it's using all those data points to give us the relative weightings we should have in the portfolio rather than 2 humans having a debate because, there's going to be a lot of error in that process, right?
So playing devil's advocate, isn't your fund a quant fund then?
It's not, because at the end of the day, you still need to pick the stocks. But you still need to do the work. So we've picked 200, what we think are 200 great stocks already. We know they're great stocks. So we've already done the work. It's not just a mechanical filter. Those are stocks that we've looked at over time. There are new ones coming from time to time when we do new research. It's not like a static number and a few sort of exit. But that 30% is where the extra work has to come in, because just because they're ranking at the top of a universe doesn't mean we buy it. Sometimes actually you don't want to buy that stock because there's something wrong. So all that's happened is the quality is good, the valuations become more attractive, but the industry structure is deteriorating, for example. So that's not, you need to do a bit more work around that. There's a bit more competition. Or yes, it's good based on history, but going forward because of, so a good example is Checkpoint Software. I think examples are always the best way to demonstrate what I'm talking about, right? So that's been ranked the second best stock in our universe consistently for the last year, and we haven't bought it, right? Because we did a whole piece of work on cybersecurity. So it's an incredibly profitable company because the guy running it he's an owner manager, which we like generally because owner managers are very aligned with every shareholder in the business. And so exciting industry. Cybersecurity spend is just going to keep going up and accelerate. I think everyone understands that. This year particularly was a pivotal point as to why that's going to happen. But the reason we didn't own it is because when we looked at management and we had there was a few of us looked at it, they used to acquire new cybersecurity segments, but they would lose the owner of that. So they lost almost the IP that came with that business every time, right? And so the concern was, as cybersecurity continues to evolve, you need a management team that understands how it's going to evolve, integrate, and a lot of execution in any business is making sure you bring the people along. So we didn't own the stock. Then there was a catalyst. He just announced that one of the leading cybersecurity venture capitalists who used to run the whole cyber defense program for Israel in the elite technology force, and then he was behind a few venture capital companies, then went on to list on NASDAQ, he was going to become the new CEO. Got you, right?
Yes.
So there we go. We've been waiting patiently. Yes. Everything was looking good. I mean, there's, they're generating a lot of cash. They're very profitable. But that's the 30%. You've got to keep working it. That's the difference. There's still an X factor there that involves people. But the important part as we move into this AI world is that you need to have a data-driven process as the core of what you're doing, because there's a lot of complex factors that go into making a decision. And in the old days where there's a team of 5 people just debating a stock, in our opinion, is no longer going to be successful in generating outperformance going forward.
Interesting. Okay. I mean, so I can imagine, like you talk about Equities, you talked about Microsoft. I can so hear some of our audience members saying, well, Monik's already told me 2 stocks I can buy. I'll just buy those 2, right? Monik's already said Microsoft's had so many quality factors driving, its returns and driving why it justifies high valuations for, decades. So the question comes out and goes, well, I just own Microsoft. I don't need to pay Monik fees, right? What would be your response to that?
Well, it's, again, a very good question. So the great thing about investing is it's been democratized.
Yep.
And there's a lot of information out there. So a lot of people are getting almost institutional style research, which was not available to the average person. If you go looking, you can subscribe to some very good research at a very modest cost. So where's the skill? So where's the So the skill basically is in a number of areas. The first thing is what you're getting in terms of what we're providing is you're getting diversification of megatrends. I'm not giving you 2 stocks. We're constantly looking for new sub-trends to invest in. And it's all about picking the right stocks, okay? So I was asked the other day, why don't I just invest in NASDAQ? Because we have a lot of NASDAQ, non-tech stocks in our portfolio. So one thing is you're getting diversification, right? But through really amazing companies, latching not onto 1 or 2 trends, but 16 trends out there. But the second part of it is the active management. So take Microsoft as an example. Microsoft we used to have close to an 8.5-9% weighting in Microsoft, which is really the upper end of what we own in a stock, okay? It's now closer to 5.
Okay.
Would the average investor know when to start trimming and selling down that stock? Our system is telling us that, yes, it's a great stock, but now it's got to a point where the valuation is greater than all the other beautiful characteristics it has. And what we've done is we've taken some of that to invest in much more attractive opportunities. So a key part of what we do is knowing when to get on a trend, which stock to buy to get the best leverage of that trend, and then when to get out of the stock, and then when to actually completely exit the trend, right? And that's where all that extra work that comes in. So yes, your audience can go and buy 1 or 2 stocks, but they're not going to get the benefits of knowing when to add, and when to get out.
Yeah.
And sometimes they get in too early without understanding why. They might like the idea, but the profitability isn't there, right? And they won't know. And as you said, they won't know when to get out. Louis Vuitton is a great long-term story, but it went from 500 up to 900 Swiss francs. It's now back to 630. Not everything's. We try to get out, obviously, and we did. We got out. A lot of our stock was above 800, right?
Yep.
And now it's interestingly still not that attractive in our universe, even though it's fallen back. So what that's telling me is that whilst the share prices come back, the earnings expectations have also come back a lot. And so the valuation compared to other things in the portfolio is still not attractive. So it's still too early to buy.
Yeah, okay.
Right? Another good example is Home Depot.
Yep.
Okay, so Home Depot, so we think US housing is structurally one of the most attractive markets to be involved in. It's the biggest generational cohort in the US is actually the millennials.
Yep.
And their millennials are the generation that are now buying their first houses.
Yep.
Okay, the US is short 3.2 million houses at the moment.
Jeez.
Okay, so it's a very, very attractive sector, and Home Depot is like Bunnings, right?
Yes.
There's Lowe's there as well, but there's to control the US DIY market. Yep. And the professional markets.
Yes.
Professionals go there and actually buy
for trade,
stuff
yep.
for
Yep.
trade as well.
Yep.
A bit like they go to Bunnings as well.
Trade, yeah, Bunnings trade.
So it's a very profitable, very stable business, very little volatility generally. About late 2023, the stocks ranking was going down and interest rates were actually going up as well. So you're kind of going, well, things are likely to soften. So we actually got out of Home Depot.
Okay.
Came back 6 months later, earnings were still the same. The valuation had come back 35%.
Yep.
The ranking of Home Depot went right up.
Okay.
We bought some, right? The stock went up 35% very quickly. The earnings were still they were just up. Again, the thing became overvalued, we pulled back.
Yep.
So it's active stock picking within mega trends,
Yes.
and it's about dynamic positioning. It's knowing when to buy, when to sell, and how much to own. And those are things that we have within our within our investment process.
Ready to take the first step in investing, or just looking to continue growing your wealth without being inundated with financial information? With SWU Online Invest, we offer a range of expertly managed portfolios designed to match your investment needs. Whether you're a seasoned investor or just getting started, know that we will work tirelessly to ensure your investments are strategically positioned to maximize your goals. Visit swuonlineinvest.com.au today.
So talk about millennials, biggest generation in the US. One of the mega trends for you is demographics. Okay, so can you walk us through, for our audience, what's the importance of demographics? I mean, we've shown our clients, and probably a lot of economists have shown this coffin-shaped issue, right? Okay, people living longer than ever, and if you're thinking about a coffin-shaped, situation, basically it's there's not enough young people funding older people, right? And probably Japan, again, we keep talking about Japan, is probably the best example of that, where there's effectively not enough young people contributing to tax revenue to basically keep older people alive. I know that sounds terrible conceptually, but is that the crux of the demographic problem? And how does that then influence how you're investing? What's so great about that for you?
Oh, I mean, you can't just invest in demographics. So the whole thing about investing in megatrends is looking at, you've got to be a bit more lateral, you've got to read a lot, but what actually, well, first of all, you've got to analyze what shifts are occurring. And as I said, I think at the beginning, the shifts we're seeing are probably the most significant in our lifetimes, okay? So not only do we have, so the aging population, everyone's kind of understood, but it's actually accelerating now. Okay, so there's more people moving into that cohort.
Oh, as in the aging population.
It's getting bigger at a faster rate.
The
number of people.
Yep.
But at the same time, we've got this number of people in the middle, which are the millennials, right? But the other group that's coming up behind them very quickly is Gen Zers. So by 2030, Gen Zers is actually going to be the largest part of the world population, 2 billion people.
2030, wait, that's only 6 years away.
Correct. Right? So this is anyone who was born between the ages of roughly 1997, 98.
Yes.
And I think 2012 or 13, because then it becomes Gen Alpha. Okay.
Okay.
Right?
Yep.
And companies are already promoting their products to Gen Alpha because they realize that that's the generation coming through, and they can because of digital media. Right, so
my son's getting it at 3.5. So yeah.
Yeah. Okay, so it's starting very early.
It's already very early.
All right, so he's already getting the brands.
Yes,
Dad, I want those, Nike shoes, or whatever, or I want hockey shoes now.
Correct.
Okay, so understanding each of those, so there's so many shifts going on, and it's actually shifting consumer taste and preferences violently. So understanding each of those shifts allows you then to go digging into what it is that it's attracting them and where the opportunities lie. Right. So one of the areas, for example, which was clearly a negative that everyone understands, is that as people get older, they tend to spend less, generally, because they kind of have everything. So they shop less, they buy less things. So brands that I grew up with are now dying, like Gap stores.
Yeah.
Right. Right. So if you invest in that, you'll be investing in it. So it would look cheaper and cheaper and cheaper and cheaper. Yes. You've got great value, great brand, but hold on, my kids aren't shopping there.
Yep.
I go and tell my children about certain brands. They're like, "What the hell's that? Never heard of it." And what are you talking about?
Like, well, I wouldn't be seen dead in this particular, a Gap T-shirt, for example.
Exactly. But so understanding that. So one of the areas that, for example, I'm going back to Zoetis actually and pet trends is, that's been an established trend for a while, and the data is actually showing that the number of pets being adopted is actually continuing to rise. Pet expenditure continues to rise, and that's what we look for. We look for a lot of data from, industry level data, what companies are saying. We're trying to corroborate and make sure that the data we're seeing is all very consistent, so we can see what the size of the market today is and where it's going to go to over time. But what's the extra piece that gives us confidence, right? And that's looking at Gen Zers. So, one of the things we looked at a lot is Gen Z surveys. And there's a lot out there in terms of what their preferences are on brands, to the things they stand for, to the type of cars they want to buy, to the whole raft of issues, okay? And one of the big surveys that's consistently come through is that, so don't forget, Gen Zers are now entering the working population. Their income is going to start accelerating. And that's the generation that is standing out to say we're going to spend more on pets than any other generation. So what does that mean for pet expenditure over the next 10 years? It's a really positive sign.
And it's structural.
It's structural. Yeah. This is the other key thing. So it's got to be structural, and that's what we think about. So a mega trend is not just a mega trend is not, we're going to net zero, and therefore renewable energy is the way to go, because it's not that straightforward. Renewable energy, yes, it's expanding, but we know it's very unprofitable. It requires a lot of government subsidies. Green hydrogen requires billions of dollars of expenditure to build a green hydrogen plant. That actually sometimes relies on solar energy, wind energy, right? So you need to have all of those in place, and those things need to be making money. And then you need those manufacturing plants to be operating at full capacity, and they're being subsidized by the government, so that when you buy a joule of energy from a green energy plant, it's cost effective. So it's really hard to work out how to make money. So we know it's what we actually call that a super driver. We don't call it a mega trend. So for it to be a mega trend, it's got to be secular, and we've got to see a very clear economic beneficiary in a profitable way come into an industry. And so we looked really hard. We were struggling to actually find a way, using our process of buying very profitable companies, investing in the megatrend. And then we were looking at it, and then one of the big areas which is emitting a lot of green emission energy are buildings. Buildings emit a lot of, through their heating and ventilation, etc.
Yeah, of course, yes.
Right.
Yes,
so if you look at the growth in buildings, they reckon in terms of urban size, there's an equivalent of New York being built every month around the world.
Jeez.
Okay.
Yeah.
Right. And there's all these new buildings that are coming up at the end of the day, and the heating and ventilation part of it, in terms of the net zero super driver, was an interesting one. So we said, okay, that's interesting, but are they making money out of that?
Yes,
Because we couldn't see that in solar, we couldn't see that in wind. They needed subsidies. HVAC systems do not get subsidies, okay? Suddenly we're finding very profitable. So we came across a company which probably most of the listeners would have heard of, which is Trane Technology, Trane.
Yep.
They're a leader in climate control technologies. If you listen to one of their conference calls, they're obsessed by it. It's in the DNA, right? Everything, they're spending billions of dollars in innovation. Their heat pump is 60% more efficient than what a heat pump was 3 or 4 years ago. So there was an example where we found a company with high levels of profitability, with a long runway of growth, that was generating a very good return on every dollar we invested. And we could see that runway going for years and years and years and years. So we actually built quite a big position in that. Okay. So that's how it works. But again, just coming back to the process, that was a big position.
Yes.
But because it's had such a strong rally, even though the earnings have gone up, the earnings have gone up, the valuation has gone up faster than the earnings, we've started to trim our position.
Okay. Yep. Again, on valuation, hence the active management. So I think there's no investing podcast that can't talk about AI, or we can't avoid the topic of AI. I remember when probably 18 months ago, when sort of the investing into AI fad sort of started kicking off, and everyone was like, oh, we've got to buy everything, it's AI, right? So you could have been, I'm being a bit facetious here, but you could be Cadbury, right, manufacturing chocolate, and then come out and say, we found a way to embed AI into our chocolate, and then Cadbury's share price would jump by 10%, right? Again, being facetious, right? I mean, where are we at in the investing journey, do you think, for AI? And from your perspective and how you've played it out in the Insync portfolios, how does that play out for you?
Okay, yeah. So again, that's a very topical and interesting question. So we think AI is profound. and it is having an impact. So just to give you one data point, Klarna, which is like an Afterpay, it's actually got a relationship with Amazon.
Yes.
So the buy now, pay later. They introduced AI into their customer service and turnaround business. And they found that it added, I think, close to $40 million in net profit after tax in terms of replacing the staff with AI in 1 year.
Cool.
Okay, so that's just an early case study of how impactful it is. Now, with every new technology, it goes through what Gartner have got a very good conceptual framework called the hype cycle. And we kind of think about these things in the same way. And the hype cycle basically is when a new technology comes, everyone gets very excited. There's a lot of investment, there's a lot of speculation, and then they suddenly realize that some of these things aren't working. So the whole thing collapses, but it actually is the real thing.
Okay.
Right? There's a law, it's called Amara's Law, A-M-A-R-A', Amara's Law. What Amara's Law basically says is investors tend to overestimate the short-term impact of a new technology, but underestimate the long-term impact. So if you think about the tech bubble, it was clearly a bubble, but we're now seeing so many great companies that have come out as a result of internet coming to play. And I think people understand that. And so that's what's happening with AI. Now, the reality in AI is that some of these early players are making real profits. It's not a bubble. So NVIDIA, whether it's sustainable or not is another issue, but they certainly are making a lot of money out of it today, right? So I would say we're probably only in if you're looking at 10 innings, we're probably just in the second innings. There's a lot of money to be made thinking about AI and how it's going to work over time and who's going to benefit. So the first stage was clearly the NVIDIAs, the chip companies.
So the hardware side of
it. They're clearly the biggest beneficiary. Then came the cloud, because to do a lot of this work, it has to be done in the cloud. So the cloud companies are clearly benefiting from that. And then that will start spreading out to other companies. So one of the big areas which we think are benefiting, because you see, the problem with AI is just basically what's out there in the general domain. So everyone sort of has access to it. And it's kind of the average, right? It sort of gives you, like even if you're investing for us, all that does is giving a sense of conception, what the consensus is. It's not actually giving us the human insight that we need. So AI, I don't think is going to replace the fund manager, but you do need to use AI to help you get to decisions quicker. So it's good at automating, good at processing information quickly, but you still need the human brain to make the final decision. So where we think AI is very good is the companies that got big proprietary data sets. So it's their proprietary, it's not only the domain, and they can use AI then to bring through a lot more information. So take Booking Holdings, one of the stocks in our portfolio. So we think travel is clearly a mega trend. And the most profitable, we looked at all the different aspects of travel. You could buy cruise liners, you can buy airlines. Hotels are quite interesting, but we found the online travel agents actually the most attractive area because it's very profitable. And if you look at most consumers now, they're increasingly using a Bookings or an Expedia or to go and book the holidays. But it's not just booking the hotel anymore. You can book airlines.
You book the package. You effectively book your whole package,
right? So if you look at Bookings, they've got 28 million listings across 100. I think it's across 120 jurisdictions around the world.
Wow!
And they have 930 booking nights that they book every year.
Jeez.
Okay, 930 million. So look at the richness information. They've got the app, so they've got all the information on you. Right? So they can now they're now inputting, they've included AI into their package. It's still early stages, but it's got to say they're going to go, okay, Jonathan Wu, we know who you are. We know where you traveled before. We're now going to create a personalized travel journey for whatever it is you're looking to do next. They're going to help you.
And then sell it.
And then sell it and get a clip of the ticket at the end of the day, right? So it's companies, another one is RELX, which you wouldn't have heard of, RELX. It's a UK company, but they own the LexisNexis database. So anyone in the legal profession would know the LexisNexis, okay? There's something like 240 million court cases that are embedded into that database. That's not available in the general World Wide Web. So if you're a lawyer and you're looking for insights on past cases, AI is going to help you enormously on the LexisNexis platform. So those companies are embedding that and are charging the customers more for it and getting the benefit out of it. So, you do need to think of AI because there are definitely really interesting money-making opportunities. Sometimes they're actually, so both RELX and Bookings have very high returns on invested capital. So it's not just a trend or a theme. You're actually buying leaders in the industry that are benefiting from that secular trend.
So I mean, your playbook for AI is actually less so about the pure hardware side. It's more about how AI is being implemented in, not, if I want for a better word, a more traditional business model, right? Because even Booking.com and your Expedias nowadays, I know it's only become sort of alive in the last sort of 20 odd years, but that is sort of a traditional business where you're implementing AI to then enhance it, right? And that is something that is scalable.
Yeah, look, I think that's certainly starting to take off now, and you just got to understand how it's going to evolve and how to participate. We're still involved in the hardware side, so we own ASML, for example.
Okay, you do, yep.
And as you know, they control 90% of those
lithography machines,
and they're the only ones who can manufacture to the level which is really great for AI at the end of the day. And then we own another company, I'm happy to share, which is called KLA Corporation. KLA Corporation, if you look at the last 5 years' returns, it's actually outperformed NVIDIA. Even though NVIDIA has gone up 5 times in the last year, KLA has been the quiet outperformer, right? And so if you think about a semiconductor process from start to finish, it's typically around 700 steps, all right? But you've got to remember, it's a very complicated process. So if one thing goes wrong with that process, the process isn't going to work. So you need a company that monitors the process and monitors the yield, which is how much of that is manufacturing successfully. And KLA actually control a large part of the market around the process and yield management. Okay, so we still own companies at that early stage. We owned a little bit long. Like Meta's another good example, right? I mean, Meta is probably, I think, recognized now, but people didn't appreciate it 18 months ago. We did write about it because we recognize they've just got so much rich data and they know everything about you, right? So the big thing that's coming through now is social e-commerce. Not e-commerce, social e-commerce. It's actually growing faster than e-commerce.
Okay, tickle me pink. Go on. Go on.
So social e-commerce basically is where you are looking at other people to give you validation that something is a good product or a service. Now, how do you get that? It's sort of an influencer, but it's a lot of people influencing you.
Yes.
Right? So when you go into Instagram, what happens?
It's stuff that you like.
Stuff you like, but you're not just going to buy it. You're looking for validation, right?
Correct.
It's all coming through the same
channel.
So they know everything. And then what happens ultimately is you click on the link within Instagram, and it takes you straight to the store, and you go and make your purchase, right? Now, who's the best positioned company in the world to do that today? Meta and TikTok.
Yes.
Right?
Yes.
And that's what's happening. They're monetizing that, and they're using AI now to accelerate that whole process. So if you're looking to brand your business successfully, are you going to use Meta or are you going to use Snapchat?
So is it fair to say that, and this sounds, the whole scary deep state sort of stuff, right, which I don't buy into per se, but the power of AI in a platform like Meta, right, and social e-commerce, as you said, is going to get to a point where they're going to know what you want to buy before you know what you want to buy.
Even as you're talking about it, it's pretty scary. It pops up on your Instagram, right?
Yes.
So this is not deep state stuff, but it kind of makes you think a little bit.
A bit that way.
I've just talked about my mum which I have, because about going on a cruise to Norway.
Yep.
There we go. So cruising. So we're all doing it, right? So I'm back onto the travel again. I've used my booking app to book it, just to so you can see how this all works.
Yes.
Cruises aren't the best business to invest in because the returns are very low. There's a lot of money that goes to building every cruise ship.
Yes.
But there I was talking to Mum about it, and then I just went and flicked up my phone and was like, what is Norwegian Cruise Lines doing on my
on your feed?
On my feed.
Yep.
Right?
Yep.
But that's so that's the power of it. And look, people like that. If you think about it, you want to be sold or promoted things that you're interested in, not a whole bunch of different things,
random
right?
Stuff, yep.
And that's why, Meta is a huge company, and their revenue growth was in excess of 20% in the last. So people saying, "Oh, we want to buy," why? isn't it all in the price? And it's not, because they've, and we like it because there's an owner-managed business like Mark Zuckerberg. He's obsessed by it, right? And that's what you want. And this is the extra bit that we look for in every company we invest in. There's an obsession. This is what makes that company that much more special. You can't pick that up in data.
Yeah, true. Yeah, that's yes, correct. That is the quality that is not screenable by a computer. Yeah. We've covered a lot in the last hour. I mean, we've talked about demographics, we've talked about megatrends, how that feeds into investment decisions. I mean, how do you see broadly in terms of the investment horizon for the next 10 years? I mean, are we looking into an environment? Do you think that because of the, as you sort of alluded to already, the raft of money that's gone into passive, giving you as an active manager more, I guess, flipping up more opportunities in times of volatility? Do you think that's actually going to increase even more going forward, right? As sort of my last question to summarize everything we've talked about, how do you see the outlook?
Look, I mean, crystal ball gazing is always a bit of a challenge, as you know, but you've got to take the factors at play and try and understand how the structural patterns are going to develop. So I think our core thinking at the end of the day is that economic volatility has definitely increased and is here to stay for the reasons I mentioned a little bit earlier. And that will lead to, so it's the disruptive forces, around localization versus globalization, being more protective than open, and that will probably be more inflationary. You think about the US, they want to onshore more, they want to cut down the migration if Trump comes in, right? And so that's got to lift prices, etc. So you're going to get a lot more volatility in that sense. I think the move into passive there will be big dislocations from time to time that will occur. So there'll be more volatility, certainly over the next 10 years. What does that actually mean for returns? Look, starting today, I mean, there's always opportunities to invest in attractive companies. And what we found is with good quality companies, even if they're a bit expensive, and let's say you got your timing wrong in the short term, because they can keep on growing their earnings sustainably, they're reinvesting and growing their book value, the value of the business every year, ultimately the share prices come back to where the earnings are, right? And valuations go up and down in the short term. So, but certainly looking at it today, things do look a little bit more expensive. So you could say, well, looking at it today, should you invest? Yes, but you've got to be mindful that things are a little bit high. But the big positive which I don't think we've factored in and people aren't talking about because they're so focused today, is the potential productivity benefits of AI and technology coming through, right? If you get a massive productivity boom, like in the 20s, so there is now a little bit of fringe thinking going on that we could be like the roaring 20s when electricity was introduced and the markets were looking a little bit expensive. We came out of a pandemic in 17, don't forget they had a pandemic in 1917, 1918, around then. We had obviously had World War I as well, but we had the pandemic. So it's very similar, but we had the electricity benefit come through. There was a paradigm shift in terms of how manufacturing done, being able to build a lot very quickly at scale. And AI could, as it starts to infuse into more businesses, actually create the same outcome. If we get that, we could get a roaring 6 or 7 years that surprises everybody because everyone is so cautious at the moment.
Yeah. That's good. Well, Monik, thank you very much for your time. We've talked about a number of stocks. We are not telling everyone to go buy or sell those stocks, and obviously listen to the disclaimer at the end of this podcast. But Monik, thank you very much for your time.
Always a pleasure, Jonathan. Thank you.
This podcast is not financial product advice and is intended to provide information only. It does not take into account the investment objectives, financial situation, or needs of any person. You should assess whether the information is appropriate for you and consider talking to a financial advisor before making any investment decisions. Any investment examples are for illustrative purposes only. The information is taken from sources which are believed to be accurate, but Simon Wu, Jonathan Wu, SWU Financial Planning, and Personal Financial Services Limited accept no liability of any kind to any person who relies on the information contained in the podcast. Unless expressly stated, none of the information should be taken as a recommendation. For more information, please visit www.simonwu.com.au.